afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 15th of August and I'm Brian Fernandez. With me is my co-host Samantha Voon. Sam, welcome to this. Everyone, welcome to the show.
All right, so let's start by taking a look at the summary of market actions. Overall, Asian markets are on a gain driven by the optimism that the Fed may lower interest rates in September. Now, this confidence was boosted by the cooler than expected consumer price index data, the CPI, signaling a slowdown in the US inflation. So this rally was further bolstered by favorable economic data from Japan and China, which boosted investors' confidence across the region. Now, in Japan, stocks rose after the second quarter GDP data showed stronger than expected growth, especially after sharp declines in the first quarter. The Nikkei 225 is up 0.79%, nearing its 2 weeks high. Now, this growth was largely driven by the recovery in consumer spending, supported by earlier wage increases negotiated by labor unions. Now, this supports the BOJ's projection that higher wages will continue to fuel spending. However, this robust growth could give the central bank room to consider further interest rate hikes, potentially limiting future market gains. Now, Brian, over to you.
Now, I want to look at China now. China saw significant gains with retail sales in July surpassing expectations, leading to increases of over 1% in the Shanghai Composite Index. Now, despite some weaker data in industrial production and fixed asset investment, as well as slight rise in unemployment to 4.2%, investor sentiment remained positive. Now, market attention now turns to the upcoming earnings reports from major e-commerce companies like Alibaba Group and JD.com, which are expected to shed light on consumer spending trends in China. Now, over in Hong Kong, the Hang Seng Index rose by 0.33%. The gains were affected by a 0.6% decline in Tencent Holdings, despite the company reporting solid quarterly earnings. Now, over in other regional markets, in Australia, the ASX 200 increased 0.15%, but stronger than expected employment data raised concerns about potential interest rate hikes, which then curtailed further gains. Now, in Singapore, the STI is up 0.71%. Malaysia, the KLCI is down 0.15%. Now, elsewhere, markets in South Korea and India are closed for the day. Now, that's it for today's market updates. Now, to give further insights into markets, we have our guest today, David Kuo, founder of the Smart Investor out of Singapore. Now, David, it's always great to have you on the show.
Yeah, so let me take a hurry, Brian.
Now, David, for a start, US inflation has started to moderate, which is a good sign. But then, how much then, in your opinion, should the Fed cut interest rates by, particularly given all the turmoil that's around in global markets right now?
It's not how much I want the Fed to cut interest rates by, it's how much the market wants interest rates to be cut by. And as Samantha was right, that inflation is coming down in the US, 2.9%. So on that front, everything looks reasonably okay. The market is asking for somewhere in the region of a 0.5% cut, 0.5 or 50 basis point cut in the Fed fund rate in September. That would be quite extraordinary if they were to cut it by 0.5%. I think the general opinion is that they will move slowly. It's a case of slowly catchy monkey. And I think 0.25% would probably be okay. It would demonstrate some kind of reservation on the part of the Federal Reserve. And they would say that, look, let's just cut it by a 0.25 point and see how things go. The problem we have is that the other side of the equation is unemployment. And the Federal Reserve has this dual mandate where they have to keep inflation under control and at the same time ensure that there isn't a rise in unemployment in the US. So it's got to try and walk this very fine line. They probably think at the moment that inflation is more or less under control now. So let's let's put that on the back burner. We don't need to look at that anymore. And let's just focus on the unemployment side and see if we can somehow manage to get full employment. The problem with that is that if they take their eye off the ball as far as inflation is concerned and focus on the employment data, they could end up in a mess. We know that there is inflation in the system, Brian. It is there. And they only have to take their foot off the brake slightly, focus on unemployment, and then suddenly inflation will come back. And what do we do then? If they had cut it by 0.5%, what are they going to do? I mean, it's going to be very difficult for them to reverse. So for the moment now, the market thinks that it's going to be an interest rate cut in September. That is more or less baked in. The question is, if it's a 0.25 point, the market may be disappointed. If it's a 0.5 percentage point cut, I think they're asking for trouble. So they've got to walk this very, very fine line, Brian.
I think Amoti from UBS also touched on this for a bit in his interview. But I also do want to ask your opinion, David, on his comment that there is fragility in the market, right, after the global sell-off. Do we need to worry about that?
Well, the thing is, well, okay, Sergio Amoti, the boss at UBS, has to talk of his own book because he is an investment banker at the end of the day. So he has to instill some kind of worry in the market. But is the worries that he is raising valid? I mean, are they justified in some ways? I mean, we saw at the beginning of this month when certain things seem to have gone wrong, we saw the Japanese market tumble something like 11% in a day. I mean, all the gains in the STI were wiped out in a matter of hours. I mean, all the gains that we've made the whole of this year were wiped out in a matter of hours. So there is some kind of fragility in the market. And the fragility that people are a little bit concerned about is war, inflation, unemployment. We've also got the yen carry trade. Whether that's been totally unwound at the moment, nobody really knows. So have all of those things disappeared? I don't think they have. I think we still have war on many horizons at the moment. We still have inflation. I mean, yes, the inflation rate is coming down, but it doesn't mean that prices are coming down. Inflation is still definitely there. And all of the other things that Sergio Amoti is alluding to, I think, are things that people need to worry about. What he's referring to, of course, is volatility. And the interesting thing about volatility is that it's only a worry if you don't know what you're investing in. If you are totally comfortable with the companies you are invested in, then volatility shouldn't really be a problem. So on that fateful day when the stock markets decided to correct or crash, I was in there buying because the companies that I buy were kind of unaffected by all of those factors. And I think that is the thing that people need to be very aware of. Know the companies that you buy, and if there is volatility, it could be a buying opportunity. So yes, Sergio Amoti is right to some extent, but at the same time, it doesn't mean that just because there is going to be volatility in the market, you have to dump all your shares and go into treasuries or bonds or something, which is something that, you know, I think he would probably want us to do.
Well, the thing is, David, just a little addition to that. The Oracle of Omaha has had its highest cash position in the entire lifetime of Berkshire Hathaway. So that should tell us something.
Well, I think it does tell us something, and I'm sure he's not just sitting on cash, but he's probably also sitting on near cash at the same time. So he's probably put his money into US treasuries, which means that if interest rates come down, the bond prices will go up, and he's going to make money there. Maybe he thinks that there's nothing in the market for him to buy, or alternatively, he might think that there is something he needs to buy, and so therefore he wants to keep his powder dry, and he's actually keeping this big cash hoard at the moment, which is phenomenal, and then he'll be able to deploy that just like that. You know, unlike some other people, if they want to go and buy something, they need to sell it first. So maybe he's already sold in readiness for buying something. What he's going to buy, I have no idea, but I'm sure we'll find out soon enough, Brian.
Now, David, I want to bring us back closer to home, and we talk about opportunities and investment opportunities and reading the signs. Now, UOB has just UOB out of Singapore has just announced plans to move some back office and mid office jobs to Malaysia. Now, that's an interesting phenomenon. How could investors take advantage of this shift?
Well, the thing is, it probably is one of the worst kept secrets around, that many Singapore operations have some of their services or some of their operations not in Singapore, but outside of Singapore. And the reasons are quite obvious. First of all, the rents here are a lot higher than over the causeway over in Malaysia. The labor costs are higher over here than they are in Malaysia. So if you are a business, what do? If you want to keep your costs under some kind of control in order to increase your margins, you have to sort of think about moving elsewhere. I mean, it is almost the same blueprint that we saw over in Hong Kong, where many operations in Hong Kong were moving their businesses over across the border to Shenzhen in order to tap, first of all, the lower labor cost, and secondly, the lower land costs. And so you ended up moving your factory or your business over to Shenzhen or somewhere in China in order to protect your margins. So I think there are opportunities there. I'm not suggesting for 1 minute that you should start selling your real estate here in Singapore or investment you have in your real estate businesses here in Singapore and invest in Malaysia. But I think we're going to be seeing this gradual move of businesses saying, I think we need to move our office to KL, for instance, which therefore means that the real estate investment trusts that are exposed to the Malaysian market would benefit in some way. It just stands to reason, Brian. So maybe have a look at companies like KLCC Staple Securities, have a look at Central REIT, have a look at, CMMT, those kind of businesses which are exposed to the Malaysian property market, but it doesn't mean you have to sell Singapore. The companies that move away from Singapore will somehow be replaced by other businesses. And those that can actually tolerate the higher operation costs, they'll say, I don't need to go to Malaysia. I'm actually quite happy in Singapore. So I think, we'll be able to play both sides at the same time rather than choose one or the other.
Okay, thank you so much for your time, David.
You're welcome.
Okay, we've been speaking to David Kuo, founder and of Smart Investor in Singapore. This has been BizTech Asia Midday Market Watch. Be sure to keep informed on the latest market updates weekdays at 1 p.m. I'm Samantha Voon.
And I'm Brian Fernandez.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.